What if I told you there's an investment strategy so simple, a child could understand it, yet it outperforms the majority of professional fund managers on Wall Street? No stock picking, no watching the news every day, no stress. By the end of this video, you'll know exactly how to use it to build real wealth. Let's get into it. Welcome back to the channel. If you're new here, this channel is all about helping you understand money and investing in plain, simple language, no jargon, no fluff. Today we're diving deep into index funds, what they are, why Warren Buffett himself has recommended them for decades, and exactly how you can start using them to build long-term wealth, even if you're starting with very little money. By the end of this video, you'll understand this strategy well enough to start applying it today. Let's get started. Let me start with a quick story. In 2007, Warren Buffett made a public bet. He wagered that a simple S&P 500 index fund would outperform a hand-picked group of hedge funds over 10 years. Funds run by some of the smartest, highest-paid investment managers in the world. The result? The index fund crushed them. Not by a little, by a lot. This wasn't luck. It happens again and again. And once you understand why, you'll understand why index funds are often called the unbeatable investment for regular people. So let's break it down from the basics. A market index is simply a list of companies grouped together to represent a section of the market. The most famous one is the S&P 500, which tracks the 500 largest publicly traded companies in the United States. Companies like Apple, Microsoft, Amazon, and hundreds of others. An index fund is an investment fund designed to mirror that list. When you buy one share of an S&P 500 index fund, you're not betting on one company, you're buying a tiny slice of all 500 companies at once. Other popular indexes include the NASDAQ 100, heavily focused on technology companies, the Total Stock Market Index, which includes thousands of companies, big and small, and global or international index funds, which give you exposure to companies outside your home country. The beauty of this is simplicity. You don't need to analyze financial statements, watch earnings calls, or guess which company will be the next big winner. You simply buy the whole market. Now let's talk about why this strategy is so powerful. There are 4 key reasons. First, instant diversification. When you invest in a single stock, you're tying your financial future to one company's performance. If that company struggles, or worse, goes bankrupt, your investment could be wiped out. With an index fund, your money is spread across hundreds, sometimes thousands of companies. If one or two underperform, the rest can offset that. This dramatically reduces your risk compared to picking individual stocks. Second, extremely low costs. Actively managed funds where a manager picks stocks trying to beat the market usually charge high fees, sometimes 1% or more per year. That might not sound like much, but over decades, those fees can eat up a huge chunk of your returns. Index funds, on the other hand, are passively managed, meaning there's no team of analysts constantly trading. As a result, fees are often a tiny fraction of that, sometimes as low as 0.03% per year. Third, consistent long-term performance. Study after study has shown that the vast majority of actively managed funds fail to beat their benchmark index over periods of 10, 15, or 20 years. Even professional fund managers, people who do this for a living, struggle to consistently outperform the market. So if the experts can't reliably beat the index, why try to do it yourself? Fourth, simplicity and peace of mind. Maybe the most underrated benefit, index investing removes emotion and stress from the equation. You're not glued to stock charts, you're not panicking during market dips. You set up your investment and you let time do the work. Now, I know what some of you might be thinking. Let's address a few common questions. Isn't this too simple to actually work? It might feel that way, but simplicity is exactly the point. Many of the most successful long-term investors, including Warren Buffett, have said that simple, low-cost index investing is the best strategy for the average investor. What about market crashes? Markets do go through downturns. That's completely normal. But historically, the overall stock market has always recovered and grown over the long term. The key is staying invested through the ups and downs rather than trying to time the market. Do I need a lot of money to start? Not at all. Many brokerages today let you start investing with very small amounts, sometimes even fractional shares for just a few dollars. The earlier you start, even with small amounts, the more time your money has to grow through compound returns. All right, let's get practical. Here's exactly how to start investing in index funds. Step 1. Open a brokerage account. Choose a reputable, low-cost brokerage. Look for one with no account minimums and low or zero trading fees. Step 2. Choose your index fund. A common beginner-friendly choice is a fund that tracks the S&P 500 or a total world stock market index. These give you broad exposure without needing to pick and choose. Step 3. Decide how much to invest. You don't need a huge amount to start. The important thing is consistency, not the size of each individual investment. Step 4. Set up automatic, regular investments. This is one of the most powerful habits you can build. By investing a fixed amount regularly, weekly, bi-weekly, or monthly, you take advantage of something called dollar cost averaging. This means you buy more shares when prices are low and fewer when prices are high, smoothing out your average cost over time. Step 5. Be patient and stay the course. This is the hardest part for most people. The market will have good years and bad years. The real wealth building happens over 10, 20, 30 years, not overnight. Let's talk about why time matters so much in this strategy. When your investments grow, they generate returns. If you reinvest those returns instead of withdrawing them, you start earning returns on your returns. This is called compound growth. And over long periods, it can turn even modest, consistent investments into significant wealth. This is exactly why starting early, even with small amounts, is often more powerful than starting later with larger amounts. Time is one of the biggest advantages an investor can have. So, to wrap things up, index funds offer diversification, low costs, strong long-term performance, and simplicity, making them one of the most effective tools for building long-term wealth, especially for everyday investors who don't want to spend hours analyzing the stock market. If you found this video helpful, hit that like button, drop a comment letting me know if you currently invest in index funds, and subscribe for more videos breaking down investing and personal finance in simple terms. Thanks for watching, and I'll see you in the next video. This video is for educational purposes only and does not constitute financial advice. Please do your own research or consult a licensed financial advisor before investing.